Morning, ladies and gentlemen. Hopefully, everyone's having a busy but smooth week. Getting ready for the weekend. I know I am. Got to do some fun snowboarding yesterday with my pops. We went to Vail. He's been shredding for like 30 years, like just an absolute amazing snowboarder. So that's what I was doing yesterday. So I thought I'd share that with you guys. But anyways, I got a couple segments to talk about. I want to talk about where the consumer is spending money and how they're spending it. What's that trend looking like? We're also going to look about on the credit side. We have tightening in banks, and the banks understand that they're tightening. And if you understand we're a debt-based economy, and if the banks are tightening, you got to understand that that's going to, you know, keep that recession keep going. It's going to deepen in it because the more access to credit, the more theoretically output we can get. And thirdly, we'll just go over Jerome Powell's remarks and why I'm a big believer that inflation will get to his 2% level before 2024, even though he disagrees. And why he disagrees is because of the unemployment number. But hopefully, you'll understand more and we'll dive into it. But first, let's take it off to Visa and MasterCard, who reported earnings this week. And they gave us some insights of how the consumer is spending their money. What are they doing with it? Visa and MasterCard sees card spending slow as inflation persists. That's to be expected, right? Purchase volumes climbed less than expected at both firms. Spending on Visa cards climbed 1.7% to 3 trillion for the first quarter, missing a 3.16 trillion average. And then Mastercard volume jumped 11% to 1.73 trillion, also missing estimates. So far, both companies have said inflation hasn't weighed on the consumer's overall spending pattern, which instead, the card's customers have shifted their spending to lower cost items or generic brands. See, that's like such a funny statement to me. But we see the consumer going from their A plus plus brands now to their B plus plus for cost cutting measures. There is obviously something in the trend that is making consumers kind of cut back on their spending. So if they, this is kind of funny how they said had no inflation impact. There's inflation impact right there. Um, and set to continue to get a boost from spending on traveling, dining out with pandemic related restrictions easing globally. Remember, Visa and MasterCard are a global company. They, make up about 50% of the market cap for each company. So of course we're going to have that global impact of new openings, especially, not only in America has there been openings, but yes, so I wanted you to take a look at what a healthy economy looks like and one that's expanding and then one that's contracting. So in red, we have advanced retail sales, what the consumer is doing. In an expansionary economy, we want retail sales to outstand the inflation, and inflation's in blue. So 2004, prior to 2007, we see this expansionary economy because retail sales are leading the inflation, which is in blue. But during a contractionary economy, we hit this peak, and then all of a sudden, inflation starts outrunning the retail sales. And then here we go. After the 2008, we have that expansionary for about 10 years. And now we are finally seeing the beginning signs of inflation starting to outpace retail sales. So another data just pointing out where the consumer is going, where we all know it's going. Still, investors have grown increasingly worried about higher prices and will ultimately force consumers to pull back on spending. We already saw it. MasterCard and Visa proved it. A move that would crimp revenues for both networks. Now, another interesting topic that I wanted to discuss is the U.S. consumers' credit and access to credit. Since rates have been hiked at an unprecedented amount, we have seen the banks take a more conservative approach to their lending standards, meaning they are strict. And if you understand how the U.S. economy works, we are a debt-based society. So in order to spur growth, we need to increase lending. Well, if the banks aren't increasing lending, well, we're not going to incur growth. We're going to have an actually contraction, almost upright deflation. And here's the beginning signs and the telltale signs. U.S. consumers hit a brick wall. December credit card growth craters as interest rates soar. Late on Tuesday, the Fed published the latest December consumer credit report, which found that in December, total U.S. consumer credit increased by 11.56 billion. I know you think that's a lot, but wait for this next step, which is not only a huge 65% drop from the number upward revised to $33.1 billion print, but also a huge 50% miss relative conscious expectation of the 25 billion. This is the biggest miss since August of 2020. So what we saw in November and now what we see in December is one, we have higher interest rates. We understand that the consumer's personal savings rate is at an all-time low. So what happens when we have high inflation, high interest rates? Well, we get this unconscious thing, I believe, in the consumer where they realize that they got to start paying down the credit card and start increasing their savings. But right now we're at the lowest amount. So that's why we're seeing the shift in consumers no longer in purchasing on goods and service, but actually paying back down debt, which is a deflationary idea because none of the money was really going to any goods and services. That's very concerning. And this is basically in blue is the tightening standards between the banks. And then red, I got total consumer credit cards owned. So this is very interesting and this is going to be fun to show you guys, but the data is here again. So as you can see, in a expansionary economy, we have credit, kind of leading and then, tightening as it peaks. So when the consumer credit peaks, that's when we see the tightening cycles start to increase, banks start holding back. But anything under the black line, demand for credit is high and it rises, and then tightening demand falls with it. So if we look at, let's take 2008, for example, we had an increasingly high movement in banks restricting capital and credit. And then what followed suit was total consumer credit owns absolutely plummeted. But then after, so that's our, contractionary economy. And then, expansionary, we have, credit kind of leading over and the demand for credit, which is under the zero line, represents high demand. Right now, we are kind of similar to we were back in 2008. We have consumers understanding that they have a lot of credit. We understand the banks are kind of restricting how much capital they're leading into the economy because the delinquencies are rising. So I thought this was a very interesting chart showing why banks are tightening and then kind of why credit is now not in demand for right now. It was earlier, prior to the last 2 years, but that it has totally shifted with the interest rates rising. What causes a sharp slowdown in consumer credit, which has traditionally increased by anywhere between 20 billion and 30 billion come rain or shine? Well, there was a sharp slowdown in revolving or credit card debt, which increased just $7.2 billion in December, a drop of more than half versus the revised November print of 15 billion. That's huge. That is a lot of credit that is gone. No longer consumers spending it. The banks are stricter now. This is an overall going to be seen as a contractionary idea for our economy because we are a debt-based society. Make money off of money. It's simple. Now, I also wanted you to look in blue. We have consumer credit cards and other revolving plans of credit at commercial banks, and then the personal savings rate. Now, we have talked about the personal savings rate quite a bit in the last couple of shows because we understand it's at an all-time low. Consumers are dipping into their savings to keep up with inflation, and this is another telltale sign between an expansionary and a monetary contractionary economy. So let's look prior to 2002. We see that consumer loans and credit cards were above that black line, which was expansionary. But then prior, we see the personal savings rate dip. And this is kind of when we were heading into the great financial crisis. But as crisis mode happens, we see that the personal savings rate goes down and consumer credit also, or access to consumer credit, drops with it. Right now, we're seeing the beginning signs of the personal savings rate started to increase as consumers start paying back their credit cards, start paying off their debt. So we should see credit cards will also come down with it back to this black line, and then hopefully personal savings rate. But right now you can see we're in the early stages, all-time low in personal savings. We got credit cards out the wazoo up high. This is going to be that cycle where those flip-flop. But the real driver behind the shocking hit was a non-revolving credit, which rose by just 4.4 billion, a huge drop compared to the $17 billion in November. So and it's on average for 16.8 billion dollars. The trend is we peaked. That's a 50% drop. That's huge. And let's also talk about kind of Jerome Powell's statements. He wants to get inflation back to that 2% level. I think what's holding him back, it has to do with the unemployment number. And we saw the jobs report come in, and now unemployment is at 3.4%. But if you've watched my prior shows, we understand that as the business owners in the economy just hired a bunch of people, they're not ready to lay them off until the second half of this year. And this is the thing that he's really judging and basing where he should move rates up or down. A government report Friday that showed hiring escalated in January was certainly strong, stronger than anyone I know. This is Jerome. Mr. Powell said Tuesday during a moderate discussion before the Economic Club in Washington, D.C. It kind of shows you why we think this will be a process to take a significant period of time. Talking about inflation. The process of lowering inflation to the Fed's goal 2% is likely to take quite a bit of time. It's not going to be we don't think smooth, Mr. Powell said. It's probably going to be bumpy. The expectations that inflation will go away quickly and painlessly is not the base case anymore. He added that the base case for me is that we'll have to do more rate increases and then we'll have to look around and see whether we've done enough. Doesn't seem very confident in his decisions. And here is kind of the data coming in. And then in red, we got gasoline prices, and then in blue we have the CPI of all consumer goods. Now, like I said, in the past I've spoken about what's keeping the CPI high is energy prices, and I think Jerome is going to go too far by increasing the rate because we already see that gasoline on a year-over-year basis is lower than 2%. And we believe that this leading indicator will certainly show the lagging effects of CPI coming down. So if he takes it too far, outright demand completely eviscerates. It's going to be a hard landing scenario for the U.S. economy. So this is what he's juggling. But you have the unemployment number, and people are starting to make more money. That's going to help inflation keep it high. So that's what he's looking at. So it's a double-edged sword. Really, a lot of data to back it. Also, let's just dive into the inventory report on oil as of this month. As you can see, the demand for oil or oil inventories have rose from 2.423 million to 2.45. So not as much demand as they expected. Supply is increasing. Thus, we should see gasoline prices. We see this with jet fuel. We see this with gasoline inventories that they start to rise. So that is a key crucial note. I believe the CPI is really reliant on energy prices, and now that we see energy starting to have a surplus of supply, would suggest that inflation will follow suit. But who knows? Mr. Jerome Powell wants to take rates even higher. He might actually initiate a hard landing scenario, not a soft landing approach by the end of next year. Hopefully you guys get some information out of it. I love doing these videos. If you have any comments or questions regarding the data or just about the show in general, feel free to reach out to me. I'm also getting a new camera next week. I'm getting rid of this old one. So thank you for all your patience, and thank you and have a wonderful day.